for your patience while we had some technical difficulties. It's, Wednesday morning here at 8 a.m. So good morning. My name is Megan Crum. I am one of the professional development specialists with the Illinois Student Assistance Commission, or ISAC, as you may know us as. And so we today are going to be talking about the income-driven repayment plan options and the countdown to April 30th, and I'll explain why April 30th is super important for you as federal student loan borrowers. So just a few things before we begin. Know that the session is being recorded, and we will share it on our on-demand webinar, whatnot, in a couple weeks so that you can access this, but you can email us as well, and we're happy to share some more information if you have questions as well, and I'll talk about that at the end. If at any point you're having trouble hearing me during today's presentation, you can call in through WebEx, so you can have WebEx call you at the number that you prefer and listen in that way. Additionally, if you are here on a laptop, you can use the Q&A feature. So that's going to be located at the bottom right-hand corner of your screen with a little question mark on it. Please feel free to ask any questions that you may have throughout the presentation. I have some colleagues on the line as well that are happy to answer those questions while we present. So additionally, we're not going to be offering any continuing education credits or professional development hours for this webinar. We do offer them usually, but just not for this type of presentation we're going to be doing today. So if you're not aware of who we are the state, ISAC is the state's college access and financial aid agency. So we support students and borrowers and many families across the state of Illinois to help with the information and providing assistance to make education beyond accessible and affordable. So we do that in a couple different ways, and we administer one of the largest state grant programs in the country. And so that is the MAP grant. Now there are other grants across the country that are similar to us in that regard, but we administer one of the largest. Additionally, though, the team that I'm on, we do a lot of different professional development for professionals, educate a variety of folks on understanding the financial aid process, different resources and supports for certain populations of students, but additionally also understanding loan repayment options for federal student loan borrowers. So what are we going to talk about today? We're going to talk about the income-driven repayment plans, or what they're also known as IDRs, the IDR payment account adjustment. I'm going to talk about how you can be eligible, as well as the impacts of the account adjustment on public service loan forgiveness, or PSLF, if you're on PSLF like I am, as well as if you already have consolidated loans or if you do need to consolidate your loans. Some questions and answers that we have from the Department of Education, and then resources that we have for you as a borrower. So let's jump right in and talk about income-driven repayment plans, or IDRs. In financial aid, we have quite a few acronyms, and this is one of them in terms of for what's going to, for all the things that happen in financial aid. This is one that happens in repayment, is the acronym for IDR. So these are 4 different types of repayment plans. So IDR, think of as an umbrella term, but there are 4 different types that you see, and that's what you see on your screen. So it's pay, save, IBR, or ICR. So they often will go by their acronyms rather than say the full name of the actual repayment plan, but you may know them as pay as you earn, saving on a valuable education plan. That's the newest one from the department. It was formerly the revised pay as you earn or repay. I currently am a federal student loan borrower, and I'm on the save plan. That's what I switched to. I was on pay when I started my loan payment. Some of you may be on income-based repayment. Some of you may be on income contingent. It just depends on what repayment plan you chose. But all 4 of these types are considered income-driven repayment plans. Now, what does that mean? It means that payment based on your income and your household size. And you have to update that information every year to say, okay, based on my income and household size, so say you have a new baby or you're taking care of someone now, your household size changed, but also the income you're changed, the amount of money that you're using to care for someone, you're using your income now to do that. So that affects these things, and so it can help lower your payment. That's the idea with an income-driven repayment plan, is that the idea is that it's meant to have a lower payment on one of these 4 options. So you do have to apply for an income-driven repayment plan. It's not automatically granted to you. Like the standard repayment plan. So when you exited school and if you didn't choose a repayment plan, you're automatically put into a standard repayment plan, which is the one that is designed to have your federal loans paid off within 10 years. So, but for the IDRs, you do have to apply for them. It's an easy process. I've done it for myself and several of my friends as well. It takes about 10 minutes, but you do that online at federal student aid, at studentaid.gov, and you do need a login to do it, but they will connect all of the things that you have, so your loans, and so that they can get that sorted with your servicer. So something we want for you all to be mindful of is you're like, maybe you don't know what repayment plan or you're like, you know what, like I know the payment pause happened and I was on this repayment plan and I think that's what I'm still on now, but maybe your situation has changed. And we want you to make an informed decision about what repayment plan is best for you. For some folks, an IDR is not the best. For many it is, but we want you to, based on which of the IDRs that you want to enroll, that you have all of the facts. So, understanding which repayment plan of the IDRs you're eligible for. So for income contingent repayment, that is often ones associated for people who are federal student loan borrowers, but they also have a Parent Plus loan. So that is specific to those types of borrowers. Again, I'm on the SAVE plan. What you'll notice is each of these have a different amount of discretionary income, but then also the repayment periods. So what's going to happen is that based on if you have undergraduate loans versus graduate loans, that will determine your time of forgiveness. So what's going to happen is that with IDRs, is that after so many years of making payments, your whatever remaining balance, if there is one, hopefully there is, amount would be forgiven. And so I know it's kind of small, but under the SAVE plan, what it would say, it says for the SAVE plan, for your repayment period, it's 20 years for your undergraduate loans, but 25 if you have graduate. So I have both graduate and undergraduate loans. So I was in school at different times, meaning my undergraduate loans would be forgiven at a different time than my graduate loans. So that time length is different, but you'll notice that for pay and for borrowers after July 1 of 2014, you have to make 20 worth of payments, okay? But then you'll see for IBR before 2014 and then the ICR plan, it's 25 years, okay? No matter if it's undergrad versus graduate. So that's something to keep in mind as you think about your repayment options. You may have been making payments that's why you're here, like I've been making payments for 20 years or even longer, and you're ready to be done and you're not sure why your loans haven't been forgiven. And that's what we'll talk about, the account adjustment. So as I mentioned, with the I plans, you are required to update your household size and your income every year. You do have to provide either your consent when you apply for your IDR application, or you have to report your taxes manually. Now this is also where you can report, if you file jointly or separately, if you're married, if you have in those things of again, you are maybe a single parent, but you have multiple children. This is where you also can upload supporting documentation to show, yes, these are the things that is my situation for my house. Now you can ask to what is called recertify your plan at any given time. So even though you only have to update your information once a year, say the middle of the year, you adopt a child or something hypothetically like that there was a change in your income, even say you are now making less money, say hypothetically again, say your spouse dies, that is a change in your situation. You can ask for your loan servicer to readjust your payment based on your current situation. Okay, you don't have to wait for that 1 year mark to update it again. You do that at any time. Okay, so your loan servicer may ask for additional documentation to say, again, maybe to show that there was a loss of income or your household size has changed. They may ask that. That's not guaranteed that they will do that, but they may want to see, okay, what about your situation has changed? Now, for some folks, consolidation is a way to help get your loans under one lender with one payment and one fixed interest rate. So now consolidation is considered a last resort for some borrowers because it's not good for everyone. It's not the best route for everyone to consolidate their federal loans. So I chose to consolidate my loans. So my undergraduate, my graduate loans would be on track to be forgiven at the same time. So I had mentioned earlier, right, that I have both. And so in that scenario, they would be forgiven at different times based on my save plan that I'm on. But because I chose to consolidate my loan, what would happen is that my loans at that point are under one lender with one fixed interest rate, and I make one payment, okay? But so my loans are completely going to be forgiven at the same time, okay? Now, what's going to happen is you do have to apply for consolidation. This is not something that is automatically granted to you. You do have to apply for it. You do that also through studentaid.gov. And once the consolidation is complete, it can't reverse. So that's the caveat to this is if you choose to consolidate your loans, which some of you will because of based on the types of loans that you have for the account adjustment, is that if you choose to go through with consolidation, you have about a 10-day grace period saying, you know what, never mind, I don't want to do this. After that 10 days is over, though, you can't undo consolidation, okay? It's going to move forward. But with that is that the consolidation takes about 30 days, okay? So it's a little bit of a lengthy process. Again, you do have to apply, but the overall is that once you apply, the Department of Education is going to talk to your loan servicers, say you have multiple, again, and the department's going to talk to all of them on your behalf saying, yep, we're going to pay all this off to make one new loan with one new interest rate. In the application, you are told what your new interest rate will be. For me, when I did my consolidation, it told me it takes an average of all of your interest rates that are there for the loans that you're consolidating. I have now a new interest rate of 5%, which is not bad. I did have for some loans, I had 6.8 for my interest rates. I had some that were lower, about 4%. So again, it takes an average. So I'm very happy with 5%. So that's just a general overview of the IDRs and consolidation, but now how does this impact the IDR payment count adjustment? So all the way back in 2022, a year ago now, actually, 2 years ago now, the department had announced that they're going to do as much as they can to help bring borrowers as close as possible to forgiveness under an income-driven repayment plan. There was an article done by NPR that had found that borrowers had been on income-driven payment plans for a lot longer than 20 or 25 years, and their loans still hadn't been forgiven. And so the department said, okay, we're gonna get our lives together here. And so they announced this this relief that said, okay, what does this look like for these borrowers? And so they took it and said, okay, for these borrowers that have been making payments for a long time, we're going to try and get them as close as possible to forgiveness, if not get them forgiveness. But then also for borrowers who have maybe been in repayment, say for 15 years, but there are payments for them that have not counted towards their overall forgiveness, they're going to review those payments and try and bring them closer to forgiveness. Now this has been a way, so they started with those borrowers back in 2022 that had been making payments for 20 or 25 years or longer. So they started with that subset group of people, and then they've moved their way through the other sets of borrowers, and I'll explain who those are. But the department had shared several weeks ago that they are hoping to have the account adjustment done in through this year, okay, through July 1. Now, some of you may be a little bit after that they'll be reviewing your account for this, and that's because of some other things I'll talk about if you do end up consolidating your loans. But for many of you, hopefully, is that your loans will be up, your payment counts on your servicers will be updated, okay, to say, okay, can you get closer to forgiveness? So the key piece here is this very last bullet point is that you are eligible for this adjustment regardless of whether you're enrolled currently in an IDR or you're not. That's the really big thing here. So if you're like, Megan, I've been on a graduated repayment plan for a long time, and I've never been on an IDR. Am I eligible for this? And yes, you are. Okay, so that is the key piece. Even if you're not currently enrolled in it, or you never were enrolled in an IDR, that is, you can still take advantage of this payment account adjustment. Okay. So who is this for? It's for people who, if you're like me, have been on an IDR before, or were on one in the past. Say you came off of an IDR But then also for those of you who have been pursuing public service loan forgiveness or PSLF, I'm one of those folks as well since I work for the state. I am pursuing PSLF from the federal government. And then even those of you who are not on an IDR, but you do have either direct or federal family educational loans or FEL loans, they're also known as FELP, you may hear it that way too, that are held by the Department of Education, okay? So I have direct loans because I went into school in 2012 and later. Some of you have direct loans. Some of you may have some of these older student loans, meaning the FEL loans. There might be, you made them as Stafford loans as well. But if you have direct loans or FEL loans that are held in department, they're not commercially held. This is for you as well. But we'll talk about for folks who do have commercially held FEL loans. So what's going to happen again is that the department started with those borrowers that had accumulated at least 20 or 25 years of payments made, and they started receiving forgiveness. And so they, again, even if they weren't currently on an IDR plan, that's that key piece, is that they started receiving that forgiveness first. So the department's going to review your account in a couple different ways. But if you have a federal student loan that's either a direct loan or a FEL loan held by the department, it's going to be done automatically, okay? You don't have to do anything. That's kind of the nice piece about this, is that as long as you have one of those types of loans, the department's going to do it for you. Now you're going to say, well, Megan, I have a direct consolidated loan. Does that count? Yes, it does. Okay, because the word direct's there first. So again, I have consolidated loans, so my account is reviewed automatically for me. I don't have to submit anything to have it, to have the adjustment done for my account. The department will do it for me. Now, again, as I mentioned, the department started with those folks that had been making payments for a long time to get them done to get their forgiveness. Then they moved on to borrowers who had at least one approved PSLF form, so that they could get their payment counts updated to help get them closer to that forgiveness for 10 years. So I'll talk about a little bit about PSLF in a little bit, but again, if you're like, well, what's PSLF? Or yes, I've been pursuing PSLF, but I have these set of payments that haven't been counting, this adjustment can hopefully get you to there. Additionally, is that after that point, this is where the department is now, is they've gone through those folks that have PSLF, or pursuing PSLF, and now they're getting to anyone else remaining, okay, that is on an IDR, but say they're not pursuing PSLF, or they're not anywhere near the 20 or 25 years to be forgiven, but say you've been making payments for 10 years, and there are maybe a year's worth of payments that don't count for you right now for the IDR forgiveness. They're going to review that now, and then hopefully get you closer. Say you get those payments added to your account. So how does this work for the loans that you have? So as you see in the top half of your screen, these are all of the eligible loans, okay? So if you have direct subsidized or unsubsidized loans, direct plus loans, direct consolidated loans, direct parent plus loans, so that's the big difference. Parent plus loans sometimes are excluded from these reliefs, but for this case, if you have a parent plus loan, you are included in this process to have your loans brought up to forgiveness. And then the FEL loans that are owned by the department, okay? These are qualifying loans. Now, this is where the April 30th deadline comes in. If you have either a commercially held FEL, Perkins, or any health education assistant loan program, or a HEAL loan, you are required to consolidate them by Tuesday, okay? So it's super important that if you're like, Megan, I don't know how to look that up, you can go into your servicer's account and it will tell you. So if you have Nelnet, if you have, like I have Mohila, you may have Aid Advantage or ECSI. Those are some of the bigger federal student loan the servicers, but you may have one that like, Megan, you didn't mention mine. So that means have commercially held loans. At that point, you have to consolidate your loans. Okay, it's required for you to say, okay, because they're commercially held, they're not held by the department. By consolidating, say, your FEL loans, what's going to happen is that it will then make them held by the department, okay? Because you would consolidate them into a direct loan, and then therefore they're held by the department, and then you're eligible to take advantage of the account adjustment. And so what they'll do though is you're like, well, Megan, if I consolidate my loans, what happens with those payments I've made on my FFEL loans that have been commercially held. They're going to review all that. They're going to look at all those payments you made and hopefully bring you closer to forgiveness. But you got to do that by Tuesday, okay? That's super key here. You got to do it by Tuesday. We are happy to help you understand the process. It doesn't take too long for consolidation to apply for the consolidation, but as long as you apply by, you need to consolidate them by Tuesday, by the 30th, you will be good, okay? So what does the payment count adjustment look like in terms of what payments will be counted for you? So the first is this really kind of this key piece is what's going to cover potentially many of you in terms of a wide, like a broad overview, a broad thing, is any payment, a payment's going to be counted for any months that you were considered in repayment by the department, okay? Or say your servicer, that if you have commercially held loans, regardless of if the payment was made. Okay, so life happens, right? You miss a payment or you have to skip a payment because of other things. As long as you were considered in repayment status, but maybe you missed a payment on accident, if regardless of your loan type, so again, that's where we see the commercially held FFEL loans and the Perkins loans. You have to consolidate them, but they're going to count those payments that you made, and then regardless of your repayment plan. Okay, so if you're like Megan, I've never been on an IDR. I've only ever been on a graduated or extended repayment plan, or I used to be on IDR, then I got off, now I'm back on. Regardless of your repayment plan, as long as you were considered in repayment status, that payment's going to count for you. Okay, so if you also at some point had at least 12 months or more consecutive forbearance, or 30 or more consecutive cumulative forbearance. So meaning that there was a postponement of your payments at some point, maybe you added the forbearance, maybe it was given to you automatically. So think of like the COVID payment pause. For those of you who have, loans held by the department, no one was required to make their loan payments, right? That we were all in considered administrative forbearance. Though those 3 years that we were on pause for, they will count towards your payment count, okay, to bring you closer to forgiveness, okay? Any month spent in economic hardship or military deferments in 2013 or later. So if this is something typically you request from your servicer to go into a deferment, again, a pause of payments. But this is, it has to be either due to economic hardship, right, or military deferment. But then any month spent in any deferment except for in-school deferment, that's the key piece here, prior to 2013. So I'm talking to those of you who are borrowers who have been, say, borrowers since the early 2000s, borrowers since maybe the 90s, okay, and you have loans before 2013, okay, and you've been making payments for quite some time. If you were spent in any deferment, okay, prior to 2013, except the in-school, because there's several levels of deferment, except for in school, those payments are going to count for you, okay? And then any time in repayment on earlier loans before consolidation of those loans into a consolidated loan. So say at some point, so I just helped a borrower actually, and she has a FFEL consolidated loan, meaning at some point she had normal FFEL loans, and then she consolidated them, okay, to help have one lender with one payment with one interest rate, right? Well, now I helped her consolidate those loans, her FFEL consolidated loan, into a direct loan because she has direct loans also because she'd been in school then. And so she's able to do that. But what's going to happen here is that those payments that she's made prior to the consolidation for direct loans, and then the payment she's made prior to the FFEL consolidated loan is also going to be reviewed. Okay. So basically, the department is going to look at your entire account time that you've been considered in repayment and do as much as they count that payment that potentially is that's considered ineligible and you closer to forgiveness. So what if you have multiple loans? So I mentioned, if you are on an IDR, right, you have undergrad versus graduate loans, they're on different timelines to be forgiven, and that's still going to hold up, right? So if but say, yes, you're like, yes, I've been paying my loans for 20 years, and, here you are, I've been on an income-based repayment, or I've been on pay for a long time, and, I've hit my 20-year mark, but my loans have still not been forgiven. you may have these loans, but you also have those graduate loans. They're going to be forgiven at different times. Okay, so it's going to take a little bit for the loan to be forgiven, but you will get notified it qualifies for this forgiveness. Um, you may still see a balance on studentaid.gov, but you also may see a balance still on your servicer's website. So once the department reviews your account, the department's got to tell themselves, say, yes, we want to forgive this person's loans. The department's going to go talk to your servicer to direct them to say, yes, this person qualifies for this forgiveness. We to move forward, giving them forgiveness. Then the servicer is going to talk back to the department and say, okay, here we are, right? So it's going to take a few weeks to see those balances updated, but no, patience is not my virtue. Okay. It never has been. It probably never will be. But it's one of those things of like, be patient as much as possible, especially if you have to consolidate. If you are required to consolidate, because again, not everyone is. If you have a direct consolidated loan like I do, or you just have direct loans in general, you're not required to consolidate your loans. Only those folks that are, who have the commercially held FFEL loans are, or the Perkins or HEAL. At that point, because that takes a little bit of time, it's where that just be as patient as much as possible, but they're working through it. So what is this? So I'm going to move into now, I know I'm a fast talker, but what does this mean for PSLF and if you already have consolidated loans, okay? So PSLF, if you're not aware, is a federal loan forgiveness program. It's for folks who work in public service, and the program works this way. It says it forgives the remaining balance on any direct loans after making 120 payments under a qualifying repayment plan while working full-time for a qualifying employer. Okay, so there's a couple different pieces in there. So you have to have a certain type of loan. You have to have made 10 years worth of payments, so that's 120. And then you have to work at least full-time, so the department considers that working at least 30-hour a week for a qualifying employer. And so the program started back in October of 2007. So any payments made after that for PSLF will count. Anything before that will not. But maybe you're like, yeah, Megan, I've been working in public service my entire life, but you've never applied for PSLF before. That's where the IDR account adjustment is going to happen. Is that hopefully the idea is that the account adjustment will get your forgiveness. If it doesn't, PSLF could potentially also get your loans forgiven. So as I mentioned, you do have to have direct loans. You have to have certain types of direct loans. You have to be employed that full time. So it's any federal, state, local, or tribal government. You have to or work for a 501c3, which is a nonprofit. So even if it is not a 501c3, so a nonprofit, but that does provide services to the public. So if you work in public education, you work in, say, a private college, but it's a nonprofit, right? If you work for a community-based organization kind of thing, or work for a hospital, right? That is considered a qualifying employer. You also can search for your employer. There's a tool that looks up qualifying employers as well. You have to make 10 years worth of payments while make the full payment amount, but also make payments under an IDR or the standard repayment plan. So in order to apply, because you have to apply for PSLF, it's not granted to you automatically. You do have to complete an application. This is also done through studentaid.gov. So if you don't have a login for studentaid.gov, I would encourage you to get one. Because all of these applications are done online. And so you create an account. It's free. It's just a username and password. They verify it with the Social Security Administration and whatnot. And then so it's a login, and then you can use these tools I've talked about. So applying for consolidation, applying for an IDR, but then also using what is called the PSLF help tool. And that's done to help you apply for PSLF. So once it's been signed and submitted, the department's going to review it. They're going to send all of your loans over to MOHELA. Okay, so MOHELA is the current federal student loan servicer that handles PSLF. You may have heard of FedLoan. I used to be with FedLoan when I was pursuing PSLF, and then FedLoan got out of the student loan game, and so MOHELA now handles all of those accounts. So what the goal would be for PSLF is that after you've made 10 years worth of payments, your loans would be forgiven. So what does this mean for those of you who are like, yeah, Megan, great, sounds great. I know what PSLF is. I've been in it for several years now, and but I have some payments that are not counting for me. So the department hopefully has started reviewing your account by now, and is going through this. So they are making these adjustments to your account automatically because again, if you already have one approved form, they know that you have the right type of loans, okay, for PSLF. So what's going to happen is they're going to look at your account and payments that are considered ineligible and try and make them eligible, okay, to bring you closer to forgiveness, okay? So some of this, they started working on this in late 2023, and that's where they're at this point of like in the spring right now of catching anyone else. But again, for some of you, it may be a little bit later just because you're required to consolidate. But know that it may be a little bit after, but they started doing these back at the late in 2023. So if you are required to consolidate or you do consolidate your loans, don't freak out, you may see your payment count reset to 0. It happened to me. I freaked out, even though I knew I wasn't supposed to, but I did. It's the department and the service are talking to each other saying, hey, we are adjusting your account. We're trying to get all of your payments together. It may go down to 0, but then you may see it skyrocket back up. Okay, so don't freak out like I did. So what's going to happen is that so even if you are required to consolidate your loans because you have the commercially held loans, the Perkins or the HEAL loans, what's going to happen is that once you consolidate them, okay, into direct loans, the department will review your account retroactively. Think of it that way, is that because you're going to consolidate by Tuesday, what will happen is that takes about 30 days, and then everything's got to get transferred in. So your loan's got to be moved into a direct loan. It's got to be assigned to a servicer. And then from there, the department's going to start reviewing. So it's going to take a little bit of time. Say you're like, Megan, I've just been making payments under an IDR, is that they're going to start reviewing your account now, hopefully. But say you've been in PSLF like I have, but they're going to be reviewing your PSLF count. So say you choose to consolidate your loans, like, yeah, I have a FEL loan plus a direct loan, and I am pursuing PSLF, and I want all of it done, forgiven at the same time, okay? The department is going to use the payments that are considered under the IDR account adjustment, they will count towards PSLF as long as you met those other requirements of PSLF of like working full-time for a qualifying employer, okay? And so again, you can use the PSLF help tool. So even if you consolidate by Tuesday, they're gonna review those payments no matter what. Okay, so there is a new thing with PSLF now is about consolidation, and it takes a weighted average. It's a lot of words on the screen, but what I'm gonna focus on is the bottom half of your screen. Is that if you're required to consolidate your loans, okay, and what will happen is normally and you're applying for PSLF, it will take a weighted average of the payments that you have. That's not going to happen, okay? Because of the IDR account adjustment, they're not going to do the weighted average for you. What they will do is they will say, okay, we're going to count as many payments as possible, okay? They're not going to say, okay, you have 60, so weighted of that, you have 2 loans is 30, you only have 30 payments. They're not going to do that. They're going to try and count all 60 payments, okay? But again, if you're required to consolidate your loans, you got to do that by Tuesday. You got to do it by the 30th. So what will happen is that if you are consolidating commercially held FEL loans, and if you work in public service, they're going to say, okay, they're going to qualify those payments from commercially held FEL loans or loans that are held under the department to count towards PSLF if you qualify for that, right? So again, if you work for a qualifying employer, even if you've not been on an IDR, okay, but if you've been on the standard repayment plan, it will count there. So what about joint consolidated loans? So this is something, borrowers used to be able to do this. You no longer can. I think we have only met maybe 1 or 2 people that have a joint consolidated loan. So this was stopped. So the Congress stopped this, I think, back in '06, that they said no more. Like borrowers cannot combine their loans anymore. What's going to happen though is that the Congress back in, I think last year, said, you know what, we believe that borrowers should be able to separate these loans now. For the longest time, joint consolidated loans could not be separated. And now they can be. So the department is reviewing what this process will look like. It is an application process, okay, to have the loans separated. So say you do have a joint consolidated loan, hypothetically, okay? You have your loan portion, your spouse has their loan portion that they came in with. Try to have it done jointly, so it's a joint application, both of you would apply to separate out the loans. Therefore, the department's going to look at how much came in with for the loan and then how much your spouse did. Okay, and it will go back to just you and them. All right, whatever the amount you came in with is your new loan amount. But say, for example, you are now divorced from that person you consolidated your loans with. What will happen is that only one borrower can be needed to request the loan separation, and that applies to their portion of the debt. Say you don't talk to your ex-spouse, or you're in contact with them, or don't have a great relationship with them. What you can do is you can apply for a separate application, and say, okay, yes, I am applying for myself. I cannot contact my ex-spouse, and I want to have just my loan separated out for myself, and you'll be able to do that. So the application process is not quite ready yet. They're hoping to do this year, again, hopefully by the end of this year. But what's going to happen is that if you do have questions, but especially if you do have the joint consolidated loans and you intend them to apply for separation, okay, contact the Federal Student Aid's Ombudsman group. Once you indicate to them, they will make a note of it, okay, so that they know what will happen is that how this will work is that if you, under the IDR account adjustment, because your loans, these joint consolidated loans, are not separated yet, they'll do it retroactively for you. Okay, so as we wrap up here, we want to just go through a few question and answers from the department. So I really touched upon this. Do I have to consolidate by April 30th? Yes, if and only if you have commercially held FFEL loans or any of those Perkins or HEAL loans. You got to do that by Tuesday, but not everyone is required to consolidate. How do I qualify for a refund if that's an option? Not everyone will, but some of you will. So if you've been making payments on your direct loans for, the 20 or 25 years, what's going to happen is that refunds are only given if they were paid in excess. If there were payments made in excess of the 20 or 25 years under a direct loan. But say you're going to be like, okay, Megan, I have a FFEL loan, but I'm going to consolidate that into a direct loan, and I've made more than the 25 years of payment. Will I get a refund? And that answer is no. The department can't refund those commercially held FFEL loans, okay, those payments. But if you already have gotten forgiveness through a different program, or you've paid off your loans, you can't receive a refund for having done that already. So you can't, they can't retroactively do it that way either. So what's going to happen is that you've paid off your loans. You can't ask to have your loans brought back because they're considered paid in full. So what about taxes? So Illinois typically follows federal law in terms of tax law. And so the federal government's not going to tax you when it comes time. Illinois will not either, but maybe you're not joining us from Illinois. Maybe you're from another state. I would encourage you to check out to see if your state does tax you for state taxes. You won't be federally taxed, but you will be state taxed potentially. And so the department, there was a law that was passed that says that there's not going to be a federal liability tax between December of 2020 all the way through January 1 of 2026. Okay. So these are for loans discharged between that time, okay? So if you're say pursuing PSLF and your loans are to be done, say this year, you're not going to be Fed taxed on it, okay? If your loans are determined that they are going to be forgiven or discharged, as it's also known as, you are going to be made aware, and you'll have 30 days to reply to the department saying if you choose to opt out. That could be because you're from a state that will tax you on it at state taxes. You have the choice to opt out of the forgiveness if you want. Again, Illinois will not tax you, but if you are in a different state, you may choose to do that. What if you have that Parent Plus loan, right? The department is going to forgive those Parent Plus loans if whether they're consolidated or not, as long as they've accumulated 25 years worth of payments. Okay. So, but say you're like, yes, Megan, I do have a Parent Plus loan, but I'm not anywhere near 25 years. Okay. What's going to happen is that you are also required to consolidate your loan. Okay, so yes, it will count for the IDR adjustment. Those payments will count, but to stay on track towards forgiveness, say for either the IDR or PSLF, you don't reach forgiveness under the what's happening right now is that you will need to consolidate your loan by Tuesday. Okay, and then you'll need to keep making payments under under the income contingent repayment plan. Okay, or ICR. So those are two certain pieces there. If you have Parent Plus loans, if you don't have a Parent Plus loan, it doesn't apply to you. Okay. But if you do have a Parent Plus loan and you don't receive forgiveness under the account adjustment, you have to consolidate and keep making payments. I think I skipped one. What if my loans are in default? Know that the department is using an initiative called Fresh Start to help bring everyone in good standing. If your loans are in default, you do have to apply for this. You'll be able to take advantage of it until September 30th of this year. And so if you're like, I have no idea if my loans are in default, Megan, go find your loan servicer, go get logged in or log into studentaid.gov and you'll be able to see if your loans are in default. So what if you have that joint consolidated loan and you can't split the loan before the adjustment, is over? Again, as I've mentioned, the department will do it retroactively. Okay, so once the loans are separated, the department's going to review their accounts. For you, say you're the one applying. They're going to review your account and then see if they can get you your forgiveness or closer to forgiveness. Okay, a couple resources. These are the current big federal student loan held things. So Ed Financial, Mohila, Aid Advantage, Nelnet, ECSI, and then the default resolution group. If you don't see yours on the screen, that's potentially telling me that you have a commercially held fellow, okay, or a different loan servicer that may be a private loan servicer as well, and those don't qualify. Private loans don't qualify for this forgiveness. It's only federal student loans or the commercially held FEL. This is just an example of a loan servicer's website. This is Mohila's specifically. You can see that it says official servicer, federal student aid. This is their login page. Majority of federal student loan servicers are going to have this banner that says this is an official servicer for them. If you're unsure of who your loan servicer is, again, I encourage you to get into studentaid.gov and they will tell you who your loan servicer is. Again, if you don't have an account, you can create one. It's just a username and password, and they're going to pull all of your repayment data, okay, and load that into the system so that you can see it, and they will so you can see who your servicer is as well as if you're in default, those kind of things. I'm going to skip to the end here just since we're right at time. We do have another webinar on Monday. So if you're like, this sounds great, Megan, but I think one of my friends would benefit from this, please feel free to share this with them. We're doing a webinar on Monday at noon. And so again, if you have any questions or they have questions, we're happy to help them as well. But we do have a final webinar on Monday to go through everything. You can submit a complaint to the department if you're like, hey, I thought my loans would be forgiven and they weren't. You can submit a complaint to have your account reviewed again to make sure that everything is up to date and everything. But if you feel like there was something not done correctly, you can submit a complaint. Beware of scammers. They're very savvy now, but just the ISAC's never going to ask you for these things. The department never will either, okay? So be mindful of that. I know things can look very real, but we're never going to ask for your username and password and those things. But we offer our services for free, you know what I mean? And so will the department, okay? We do have an evaluation, so even though we don't offer CE and PD hours, we'd still love to hear from you just about today's session. My colleague is going to drop that in the chat, which is in the lower right-hand corner of your screen. You'll have until Friday at 11:59 to submit that evaluation. And so we thank you so much. I know I'm 2 minutes over time here, but thank you so much for listening to me ramble. If you have any questions, please feel free to reach out at isac.borrowersupport@illinois.gov, and we are happy to walk you through this process and help you understand, hey, I got this in my mail, but I'm not quite sure what it is or what you need to do for consolidation. We're happy to help you. So thank you so much and have a great rest of your Wednesday.